Hello again! In this video I will elaborate on the three methods introduced in our previous video. Let's look at the following example. At the timeline we notice an initial investment at T0 of 1,000 euros. The project will last for 6 years and in each year 250 euros will be available to return to the funders. At the end of the project we can notice another 750 euros will be transferred back into cash. All of these cash flows are free for interest payments, repayments of the principal and dividends to our shareholders. The payback period is the length of the period for the initial investment to be covered by the future cash flows. In this example, it will take 4 years to cover the initial investment of 1,000 euros. Obviously, a project is approvable when the payback time is shorter than the length of the project itself. When comparing two different projects, the project with the lowest payback time is preferred. The simplicity of this technique is one of the main advantages. However, this method does not take into account time value of money and risk. And remember those to be the basic principles in finance. Furthermore, cash flow after the payback time is not taken into account when different projects are compared. We can adjust our method to time value of money and risk. We call that the adjusted payback time. Instead of using the individual 250 euros for each year, we use the value of those figures at the starting date. We calculate the present value by using a discount rate. The discount rate reflects the project's risk. By doing so, we include risk in this adjustment. And that is giving meaning to the higher returns required by external funders when they invest their money in our project. More risky projects deserve higher discount rates. The higher the discount rate, the higher the payback time, and thus lowering preference. Yet, cash flows after the payback time still does not affect the investment decision. How to deal with this aspect? An answer to this question is the net present value method. Instead of only taking into consideration cash flows up to the PBT, we include all cash flows. First, we calculate the sum of the present value of all cash flows, and to that we add the initial cash outflow. If the outcome is positive, then the project is approvable. When comparing different projects, we prefer that project with the highest NPV. Notice that the discount rate reflects the project's risk. Our last capital budgeting technique can be seen as an advanced NPV calculation. Taking a deeper look into the NPV method, you might wonder the meaning when NPV equals 0. Well, in this case, the average percentage return equals the cost of capital needed for funding. We call this average return the internal rate of return. It reflects the average yearly return of a project during its lifetime. When the IRR of the project exceeds the cost of capital, reflected in the discount rate, the project gains more than the cost needed. Then the project is approved. In general terms speaking, project's priorities reflects the IRR.